Insurance fraud. Insurance fraud is a deliberate deception perpetrated against or by an insurance company or agent for financial gain.
Fraud may be committed at different points by applicants, policyholders, third-party claimants, or professionals who provide services to claimants. Insurance agents and company employees may also commit insurance fraud.
Common frauds include padding, misrepresenting facts on an insurance application, submitting claims for injuries or damage that never occurred, and staging accidents.
People who commit insurance fraud include organized criminals who steal large sums through fraudulent business activities, professionals and technicians who inflate service costs or charge for services not rendered, and ordinary people who want to cover their deductible or view filing a claim as an opportunity to make a little money.
How insurance fraud works. Insurance fraud occurs when someone makes a false or exaggerated insurance claim, or intentionally provides false information to their insurer in order to receive a payout that they are not entitled to. This can occur in various types of insurance, including car, health, property, and life insurance.
Here are some common ways that insurance fraud can occur. 1. Staged accidents. One of the most common types of insurance fraud is when a driver deliberately causes a car accident or stages an accident in order to make an insurance claim.
2. Exaggerated claims. Some people will exaggerate the extent of their injuries or property damage in order to receive a higher payout from their insurance company.
3. Phantom policies. This type of fraud involves the sale of fake insurance policies to unsuspecting customers. The fraudster will collect premiums from the customer, but the policy is worthless and the customer is not actually insured.
4. Arson. In cases of property insurance, an individual may intentionally set fire to their own property in order to make a claim for damages.
5. Health insurance fraud. This can include submitting false claims for medical services or equipment that were never received or were not medically necessary.
6. Life insurance fraud. This can involve lying about medical conditions or other information in order to secure a life insurance policy, or faking a death in order to collect a payout.
Insurance fraud is illegal and can result in serious consequences, including fines and imprisonment. It can also drive up insurance premiums for everyone, as insurers may need to increase rates to cover the cost of fraudulent claims.
Types of insurance fraud. There are several types of insurance fraud, including health insurance fraud. This occurs when individuals or healthcare providers submit false claims for medical treatments or services that were not actually provided or were unnecessary.
Auto insurance fraud. This occurs when individuals or groups stage car accidents, exaggerate claims, or submit false information to collect insurance payouts.
Property insurance fraud. This occurs when individuals or groups make false claims for damages or loss of property, or commit arson to collect insurance payouts.
Life insurance fraud. This occurs when individuals provide false information on life insurance applications or make false claims for death benefits.
Workers' compensation fraud. This occurs when employees or employers submit false claims for work-related injuries or illnesses to collect insurance payouts.
Fraudulent insurance selling. Some fraudsters pose as insurance agents and sell fake policies to unknowing consumers.
Detecting insurance fraud. Insurance fraud can be detected using a variety of methods, including data analysis and investigation. Data analysis techniques such as statistical modeling and machine learning can be used to identify patterns and anomalies in claims data that may indicate fraudulent activity. Some insurance companies also use third-party firms specializing in fraud detection and investigation.
Insurance fraud can be detected through a variety of methods, including 1. Data analysis. Insurers can analyze claims data to detect patterns of fraud, such as a high frequency of claims by certain individuals or groups.
2. Investigation. Insurers can conduct investigations into suspicious claims, including interviewing claimants and witnesses, and reviewing medical and financial records.
3. Technology. Insurers can use technologies such as predictive modeling, data mining, and artificial intelligence to identify potential cases of fraud.
4. Collaboration. Insurers can work together with law enforcement agencies and other organizations to share information and identify potential cases of fraud.
5. Training. Insurers can provide training to employees and policyholders on how to identify and report potential cases of fraud.
Tips to ensure that you never fall victim to an insurance fraud. Ask the insurance agent for ID proof. According to strict directives issued by the IRDA to insurance agencies, all agents working on behalf of insurance companies need to undergo stringent training and also need to acquire a proof of identification.
Never pay in cash. No insurance agent will ever ask you for cash. Also, in order to ensure that you are writing the check to the right account, you should call the customer care center and confirm the details to be mentioned on the check.
Do not disclose details of your policy. Divulging details of your policy documents to an unknown third party is a surefire way of attracting insurance fraud cases. Sometimes, a fraudster might pose as an insurance agent, asking you for details about your policy.
Purchase insurance policies online. If you would altogether like to avoid the risk of insurance frauds and buy insurance policies without having to deal with an agent, you can instead purchase your policy online. Not only will this cut out the middleman, but also guarantee a safe and transparent transaction.
Ensure that you write policy documents yourself. If you choose to go via the offline route when purchasing insurance, you should ensure that you fill in the policy documents yourself to avoid insurance fraud cases. Read and understand the terms and conditions, inclusions and exclusions, and check for spelling errors, withholding of information, and misrepresentation of facts if the policy document is being filled in by an agent on your behalf.
In conclusion, insurance fraud is a serious problem that can lead to increased costs for both insurers and policyholders. However, there are various methods to detect and prevent insurance fraud, including data analysis, investigation, technology, collaboration, and training.
By taking proactive measures to combat insurance fraud, insurers can protect themselves and their policyholders from financial loss and help ensure the integrity of the insurance industry.